hold on. I said ready. You said yes. And then you can't say hold on.
Yeah.
Come on. We're starting here.
Back in high school.
All right, listen, we got a lot to talk about, Jeff. So let's get ready. We're back. Summer's over. We're back on the Presidio Perspective. We got Pal talking this morning. Pal speaks, market listens. All right, we want to do a little review of what's happened in the markets. How do we get here with this inflation? Talk about where the current opportunities are. And we got new IRS proposed rules that are affecting people's RMDs and distribution planning. Has big implications for folks. So we got a lot to cover. So I'll ask again, are you ready?
I'm ready to start.
All right, cool. Sierra, you ready? Let's hit it. All right, back from.
Yes, we are.
Yes, we are. So let's see. I think we ended a couple months ago doing a recap of the first 6 months of the year.
So we don't need to revisit that.
Yeah, that wasn't fun. We don't need to relive that yet again. I think we all know first 6 months wasn't good. So kind of what's happened since. Let's do a little bit of that. Maybe you can just talk about what happened since the last time we were on air. And then, we've had some big news come from the Fed this morning that we want to get into.
Yeah. So you want to start with the Fed?
Sure.
Let's do that, and then we'll kind of backtrack. So
sounds good.
The Fed doesn't meet on in the month of August because it's their time off, but somehow they find their way to get back in the news. The Kansas City Fed, which is one of the Fed departments, I guess you could call it, holds a symposium or an economic symposium in Jackson Hole.
Right.
Happened today.
Mm-hmm.
Everybody waiting for Fed Powell to talk about inflation and interest rates, which we've been talking about now for 8 months?
Yeah,
it's already
not
August.
My entire career, but yes, a lot.
But
more
especially
recently.
now, just kind of that seems to be the everything hanging on that. And Powell came out, and I think the market had rallied. Well, the market did rally off the lows late June, with the idea that, hey, we think as traders and speculators, we have an idea where we think interest rates are going to end, where they're going to top out, and maybe they're going to start cutting. Because we think that the Fed is eventually going to balk, and they're not going to keep raising rates, and inflation will come down, and the Fed put is in full effect, which meaning they're going to take care of us and they care about the markets. Well, we talked about it before. What does the Fed care about right now? Price stability
and inflation.
And inflation continues to run hot. It did moderate a little bit last month. So we peaked at 9.1. We clocked in at 8.5 in July.
Right. It's coming down. I've noticed it at the pump, at least. I mean, you've seen prices come down.
Right. And actually the funny thing is the bottom of the market, at least coming into now, was almost directly related to top out in gas prices. Right. You can look at it on a chart. Gas prices topped out, came down, market kind of bottomed, maximum fear kind of,
it's immediate data that people are processing.
Right. So everybody figured Powell will come out and say something dovish, and the market kind of anticipated that. It ran up, and he did not do that this morning. What he did was he came out with the quotes, going to bring down inflation, and they'll bring some more pain to households and businesses, but these are the unfortunate costs of reducing inflation. And he's been saying that before, and rates are going to stay higher for longer, and maybe may go higher than what they thought or priced in.
So kind of summarizing what you said, right? So we had record level inflation, highest in the last 40 years, reached CPI hit 9.1. I mean, it was out of control. We all were feeling it. And so the Fed has to change course and start being aggressive and raising rates, selling bonds, which also increase rates. And so they were taking what is called a hawkish stance, right? So trying to pull money out of the economy, right, to bring prices down. So that started to happen, and they were like, well, how long are they going to do that? Well, maybe once they see inflation kind of getting under control. So then we saw inflation come down. It's like, okay, inflation is down, gas prices are down. Are they going to say, hey, it looks like it's been working, something like that? And it's not that. Yeah, some of these quotes are, we are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and keep inflation expectations anchored. We'll keep it up until we're confident the job is done. Reducing inflation is likely to require a sustained period of below trend growth. These are not things that the stock market likes to hear. there will very likely be some softening of labor market conditions. Higher interest rates, slower growth, softer labor market conditions will bring down inflation.
Right.
Well, okay. So we kind of know that. This will also bring some pain to households and businesses.
You don't like to hear the word pain from the Fed.
Right. So the stock market obviously is digesting this today. You know, it certainly got sent lower this morning. He did say he was pleased to see the lower July inflation reading, but quickly added a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
Right.
Okay. So, you know, we moved out of the basement, right? Going back to my analogy that I've been using, right? We had this nice allowance, you know, we were on dad's car insurance, you know, our cell phone bills were being paid for, you know, we had to worry about our gas and beer money. And they're like, okay, go and make something of yourself. And so, hey, here we are, 8-9 months later. And we're like, hey, Dad, you know, it's pretty hard out there. Can I come back home? Thinking that he'd say, sure, son. And he said, no, yeah, there's going to be hard times. Yeah, that's part of the plan. This was anticipated. So get back out there and go to work.
Yeah, perfect analogy.
I mean, that's kind of what we're seeing.
Exactly.
Yeah. I mean, it's interesting. I did a big presentation a couple of weeks ago to a group here in San Diego, and so I was kind of in preparation of that. Was kind of looking at, you know, historical savings rates and debt trends, and it was just really interesting to kind of look back at that and see, you know, how we got to this place. And really all the dots are connecting. You know, we're just still dealing with COVID. Let's bring up this slide, see if we can. So. Look at this, Jeff. So here's the U.S. personal savings rate, right? Going back to the 50s.
Mm-hmm.
Okay. So what is this? 70 years of data, 60, 70 years of data. So, you know, since the 90s, U.S. savings rate has been below 10%, right? We kind of are in that 5 to 10% window.
Right.
In 2006, 7, and I was in this business, and I remember we dropped below 5%, and I think it went negative, like right before that.
You can see it in the chart.
Recession. Yeah. It doesn't hit the negative because I don't know, but I remember for that year, that reading, because it when you factored in the borrowing on people's equity, I think it kind of came down. But anyway, look what happened during COVID. Okay, so. You know, we had a savings rate of 35% it looks like on this chart. I mean, that's insane. That's a clear outlier, right? Something's going on. And so what happened? Well, you couldn't spend your money if you wanted to. There's nowhere to go, right? Not to mention the government printed a bunch of money and gave it to us. Gave it to businesses, which gave it to their employees, and then also, you know, all these federal programs providing unemployment support and further assistance and all kinds of tax credits. So we got flooded with cash, and then there was nothing to do. You couldn't spend it if you wanted to, right? You weren't buying a plane ticket, you know, and then finally maybe some restaurants opened up. You did whatever. You got your Uber Eats, and then you went and bought Dogecoin or meme stocks or, you know, whatever.
Something to pass the time.
Sprinter vans, Winnebagos, Teslas. You got your orders in, right? There's a buying frenzy.
Yep.
And so once, you know, we kind of economy's opening up, people have all this cash. I mean, just look at the savings rate. You can just think of the United States with that savings rate for that period of time. And all of a sudden there's just all of this demand, and there's been a backlog limit of supply. Of course, you're going to have crazy inflation. Well, here we are. You can just see the plummet that has been going on. And so, you know, the economy and the job market was super hot last year. We had the Great Resignation, and now we're starting to see major companies put on hiring freezes. Like It is a different story out there, right? And
it's a 180.
A complete 180. And so you had all of these people thinking, hey, I'm never going back into an office. I'm going to work from my van for the rest of my life. I'm going to just trade my meme stocks for a living. I'm going to do whatever, right? And so, you know, you've seen this pivot, but people are still spending, you know? And so that's what's happening. And let's come back to that with Powell's tone, right? Let's talk about Dad's tone right now, okay? Because look at this on our next chart. See, can you bring up the credit card debt? Yeah, perfect. That one. So here you can see here's U.S. credit card debt going back to 2000. Okay, so, it kind of runs up going into a recession. You see this thing. We go through this deleveraging event. It runs up going into COVID. Credit card debt's going down, right? Why? Well, one, I can't charge it. Two, I have all of this money that I can't spend, so I'm reducing credit card debt.
Yeah.
And then now what happens, right? And you just see it start to spike again. And so people are now in this position where they're earning less and spending more. And so this is keeping inflation hot, right? But we are starting to see that break. I can see it. I know you can see it.
Yep.
I don't think a lot of people can see it. And so some of this news seems really scary. And we'll talk about how temporary all of this stuff is, right? We're not going to go do anything crazy or do anything silly. Is that my slogan here on the Presidio Perspective? But, so here we are, right? And so dad's coming out and saying, hey, it's time to get real, kind of shaking you, right?
Yeah.
I mean, instituting a little fear into the U.S. consumer in the short term will bring down inflation. Maybe even more than the federal rate hike, just having that fear. And that is the balance that we're experiencing right now of soft landing, hard landing, recession. He did say that it looks like, the likelihood of a recession. On worries about a possible recession, Powell said that he sees strong underlying momentum in the economy. So he's not worried about that.
They see all the data. I mean, that's what they do, right?
Yeah.
And they actually... they talk to other central banks. They talk to hedge fund managers, pension fund managers. They talk to private equity. They do their own in-house research. They talk to traders. They're always looking at every facet of the economy. He told us what we needed to hear, but not what we wanted to hear.
Yeah.
And that's definitely important. But, that first chart is great because that spike in the savings rate, it's almost like, we got hit with the paddles during a heart attack. And maybe we got just a little too much adrenaline there. And we talked about that before with inflation, just too much money chasing too few goods. And when the market started to rise off the back half, and we talked about how usually when you have really bad starts to markets, the back half is usually better. Mm-hmm. On top of coming into a midterm election where we think there's going to be a Republican victory in the House and the Senate, although that may change.
That's changed. Those changing. Probabilities have shifted a lot.
There's some there's some geopolitical things going on internally, or social issues that may change that. But those are typically good for the back half, just a really bad first half and all these things. But we are nowhere near where the Fed would like us to be in terms of price stability, inflation. But when the market goes up, what does that do? It creates a wealth effect. People feel wealthier, right? And so when they feel wealthier, they're spending more. He's trying to soften demand. That's the whole point of raising rates, is to bring down demand, to meet the supply issues. Yeah. And so we go back and forth with, well, what does this all mean? It's like, why are we raising rates? We talked about it before. That's why they raise rates, to bring down demand, to bring supply and demand in equilibrium. So he's going to continue doing that until he's willing to take a softer economy. But he's saying that the economy is stronger.
Too strong.
Strong.
We are going to weaken the economy. Let's just say that's in a nutshell what he said. That's what we're trying to do. So there's going to be job losses. There's going to be less growth, right? So those are going to affect U.S. households. They're going to affect businesses. They're going to affect valuations on companies.
Right.
I mean, so, being prepared for that as an investor, being prepared for that as a household, I think is really important for people to pay attention to. Look, we've talked about this. We talk about this every day here at the offices of Presidio, but you can kind of see this playbook. You don't really have all of the exact timing. We have a good sense looking back historically, what these kind of bear markets look like. But, coming back to what I was saying, we're coming off of a super hot labor market with a lot of demand, a very strong consumer, too strong on all fronts. Okay, so it's not that we're going to be in this dire situation, but just getting into something that's a little bit more normalized and
sustainable.
Sustainable, thank you. Right. So in a sustainable state for an economy, because it wasn't sustainable.
Right.
I mean, go to LA or San Francisco and look at the tent cities and what's going on. I mean, you can only push that so far. And so there's a strong mandate to bring prices down significantly, So if housing rolls over, that's going to be looked at as a good thing, right? For politicians, it's a good thing for the Fed, right? It's a good thing for inflation reading. So it's like, well, they're probably not going to save you there. But we look at these trends. The stock market is our leading indicator, right? The stock market's the thing that's going up when there's structure fires, social unrest, riots, a deadly global pandemic that's supposed to wipe out half the planet, and the stock market's just going up. What the heck, And then here we are, the stock market, one of the best employment markets we've ever had, one of the best, strongest stock markets we've ever had, new innovative technology, super low interest rates, housing soaring, and the stock market starts crashing. You're like, what the heck, right? So there is this bifurcation of what we're talking about with economic data and what the stock market's going to do.
Yeah.
And so always important to keep that in the forefront of your mind when you're making decisions. Now, in this market, I would argue it's pretty important not to have all of your eggs in one basket. And those are the people who've been damaged the most, who got really suckered in, or maybe that's not the right word, lured to sleep with these fantastic returns in these concentrated pockets of the stock market. Right. I mean, if we just look at the different areas of the stock market here year to date, and so what do we look at as a broad, diversified U.S. stock market portfolio? You have your S&P, your Russell, mid cap, small cap, your bonds, and then you kind of look at the NASDAQ 100 here by the ticker QQQ. So, I mean, you can see that, over the last 5 years, last 3 years, that NASDAQ has been our top performers, and those are the big, mega tech stocks that we all know and love and want to own, but, they experience the most pain. Right. So as we go through these bear markets, it's important to have that ballast in your portfolio, right? Because we're going to have a lot more Fed meetings. They're taking a very hawkish stance, and that's going to punish certain pockets of the market a lot more than others. And if you have that diversification, you can rebalance to buy more of that stuff that that you want to own and love at potentially lower prices. Right. Using the stability from some of the other stuff. Say something more focused on value or dividends, right? That can go and buy growth.
Right.
Growth does not like this market.
Does not.
Growth does not do well when we're trying to limit growth, right? Growth does not do well when we're increasing the discount rate.
Right.
Okay. So now we have more pain to go. And once we kind of see on the other side that may be okay, but no time soon is the Fed going to turn dovish.
No.
Certainly.
No.
So I just want to make that note, right? But we're already 9 months in, Jeff. Here we are. It's the end of August. This bear market started in November, right? And so what does history tell us? And you've gone over
I think
this
you've got the chart for it.
I do.
Yeah.
I do. So, if we go back over the last 80 years and look at what's happened, right? And we can just look at, these are bull markets in blue. These are bear markets in yellow. What color do we see more, blue or yellow? Which color do we see more, Jeff?
We see blue.
I feel like I've been talking for a while. Thought I'd throw you an easy
See
one.
if I'm still awake.
Yeah. But I mean, look at this. I mean, these blue these are long, enduring growth periods that usually happen. This is usually what we see, is we usually see good times. And of course, there's plenty of volatility. If we kind of dove into there, we'd see all kinds of crises and events and worries. There's always that wall of worry. We're always stressed. We're fighting wars during these times. We're doing all this kind of stuff. But you see that they last on average a lot longer than bear markets. 6 years, 12 years, 7 years, where the market is on average doing 15%, 16%, 23%, 20%. I'm just picking a few at random.
Not to mention how they're shorter, but they're so steep and they're sudden. It's one of the adages they use is bull markets are kind of the escalator up, and bear markets are like the elevator.
Yeah, that's a great analogy. And so then, turning to these bear markets, what do we notice? They are quick, severe, you know, and we're losing 30%, 26%, 28%. You know, we kind of hit some of those lows. You know, the NASDAQ was down, almost over 30% this year at its low, right, year to date. So we can see these bear markets, and in pockets of the market, this is just the S&P 500. There's other pockets that have experienced severe bear markets so far year to date. But we're 9 months in, right? I mean, this is, I think, as of June 30. So, you know, you tack on couple more months.
I think we're in our 10th month now.
Yeah.
It started in November, really.
Yeah. So August would be 8 months.
November and December.
Yeah, that's good.
Started at the beginning.
I'm working on my arithmetic.
I'll get you there.
Thank you. But so they're not that long. We look at these bear markets and we have to know what's on the other side. And as investors, this is why, I mean, a lot of novice investors, the people who haven't been doing this for a while, think, hey, we're in a bear market. I'm going to go to cash. You know, I'm in a bear market. I got to pull out. I'm just going to plug all my money into something that's working. Stock market's down. My real estate's up. I'm going to get out of the stock market. I'm going to go buy real estate or gold or whatever you might do, right?
Chasing something or running away from something. It's just not a plan.
No, I mean, catch your strategy and know that your strategy is going to go through market cycles, right? And you can make tweaks on the margin. Having some dynamic to shift some of your growth to core or value is just a prudent move, one would argue. But, you know,
making timing guesses is just not.
It's very difficult to do.
Right.
But either way, how much longer do we have to go? So it's important for investors to have this also in the forefront of their mind as, you know, this is going to be temporary, right? These don't last that long.
But they never feel temporary, do they?
No, they don't. And the funny thing is these bear markets don't always coincide with recessions, which are in gray. You can see there's some correlation, certainly. But what do we notice about recessions? They are also not that long, right? So this is just to kind of tell the story of the stock market, right? So it's not as much as like what's happening in the job market or inflation data or anything like that. I mean, this is just kind of what you see as an investor. And so, look, hard times maybe come with some hard decisions. But, you know, what do you want to do during hard times? Like, you're not wanting to sell, right? You want to buy. Typically, you're not wanting to spend more. You'd like to save more and invest more because it's the best time to invest.
Right.
And that's not what happens. And we're seeing it. I mean, just the tone last year of people wanting to participate and get more aggressive in their portfolios versus the time when you want to become more aggressive in the portfolios, everyone's kind of thinking the opposite.
And we do this we just do this every cycle. And in general, people just don't learn. So it becomes more and more, it just...
I think it's, I don't even know if it's a learnable skill. And I think that's very good for you and I, because we have job security. This is our job. But I have a very difficult time retaining my own emotions for my own investing. So, and I'm very learned on the subject of when to buy and sell and dollar cost average and invest. And I could tell, like, you feel them too. Those emotions are just a part of us with that fear and greed and that worry. So that's just the importance of having that strategy that's written down, that you review, and that you anticipate these things happening. And they're just all part of that process. They're just all part of that plan.
Yeah, good point.
Okay. I want to move in. We have some really significant changes that are going to affect people with their IRA and 401k distribution planning that we need to start talking about. So we had the IRS has proposed new rules in how inherited IRAs are to be distributed. So in 2019 we had the Secure Act. So before then, financial advisors, planners knew this forever. Investors, we did something called a stretch IRA. And if you were really savvy, you got your Roth conversions done and you had a stretch Roth IRA. Ed Slott, the IRA guru, wrote all about it, all these books about it. And it's a fantastic way to preserve and build wealth over time for generations. And I mean, you know, you take a little small account, you do some Roth conversions, and you look at the difference of that compounding tax-free versus paying ordinary income tax with RMDs the whole way. And I mean, it's, you've run it out over a couple generations. It's like $90 million of savings, right? It was something crazy. But anyway, they eliminated the ability to take distributions out over your lifetime. So like the idea was you would leave your Roth IRA to your grandchild because their lifetime, basically take 100 minus your age, right? That's how much about the IRS says you're going to live from an RMD table perspective. Mm-hmm. So when you're 72, they say you're going to live about 28 years, right? It's 27.4. But just in general, if you don't, if you just kind of want to know about what that is, so then you take your $1 million and divide it by 28, and that's kind of how much you have to take out. It's about 3.6, 3.7%, right? If you were 72. If you were, 20, you have to take out about 1%. Right. And so you're able to kind of keep and preserve this tax-free status for a very long time of growth, which is wonderful. Okay. So the Secure Act in 2019 happened. Can't do that anymore. All IRAs, 401ks, Roth IRAs, Roth 401ks, whatever, your qualified retirement plans have to be distributed within 10 years. Okay. So no more stretch. Okay. So cut that off. But then also they kind of said, but whenever, just within 10 years, and there's a couple of different schedules and things you could do, but if you did a lump sum at the end of 10 years, that was fine. Well, the IRS is saying, no, we don't like that. You are forced to take some required amount. Okay. So, there's been some confusion about how much you have to take out. So I think I just wanted to mention this. Okay. Cause it has a lot of implications in how people prepare their financial plan. So we're going back, it looks like, to the stretch IRA rules. Now, this still has to be put into regulation, but this looks like where we're going. So now it's still going to be based on your age. So now beneficiary selection of who you leave Roth IRAs to is pretty important when it comes to distribution planning, right? Because it's going to be based on their age. So if you leave something to a 70-year-old, right, they have to take it out about 3% a year versus a 50-year-old has to take out 2% a year. And so the less you have to take out, the more compounded tax-free growth you would have, like right. if it was a Roth, or the more you can defer taxes to potentially lower rates, say if it was a non-Roth traditional IRA. So what does this all mean? Aside from there's some tax compliance that people have to pay attention to with their inherited IRAs, it has implications for how you build and prepare your financial plan. And we talk a lot on this podcast, in our courses, in our client meetings, continuously about the importance of having a distribution strategy for your qualified accounts and getting your Roth conversion strategy dialed in and getting scientific. And ready for battle and having a strategy to implement throughout the year. Okay, and I'll talk about some of the timing, but it's so critical that people do this. And we just get lulled to sleep looking at how much money we have in retirement accounts and saying that's our money. It's like, no, it's not. You got $1 million of retirement money, maybe have 600. You have a big tax liability and you're pretending like it's not there. At what point do you want to stop pretending? Because the government's going to force you to stop pretending when you're 72, when that's the new RMD age. And then if not, you're just going to let somebody else pay your debts, your unpaid taxes. And so when we run out financial plans, we show people, here's what it ends up being when you pass. And they go, what's that? What's that line item? That big 7-figure red number? And we go, that's IRD. Like, well, what's IRD? Well, that's income in respect of a decedent. What's that? Well, that's the earned income that you've accumulated over your lifetime that you never paid taxes on. And so you have a unpaid tax that you've been carrying with you that is growing exponentially throughout your lifetime. And the more we show people this IRD, the stronger convictions they have about addressing it, because it's real and it's getting worse, pretty obviously. It's getting worse. Taxes pay off our debts, and we're running a bigger and bigger deficit every year. So, future generations, I wouldn't anticipate less taxation, right?
No, that's for sure.
So you're going to not pay the taxes during your life. You're going to leave the kids with a country riddled with debt and high tax rates, and you're going to leave them a big account with unpaid taxes on it. Like, okay, maybe you don't care. That's fine. But if you do, what's the best strategy? Because at the end of the day, you're doing all this hard work. You're doing all the savings for what? For the government to take it and pay off the debts that, well, your generation maybe have accumulated anyway, right? So maybe we should pay off our debts at the end.
Yeah.
But, all right, I digress. Sorry, went off on a little. But let's just put this in perspective. You have $1 million. For every $1 million of retirement money you have, okay? And let's say you retire, and you're like, okay, what should I do? Let's say over and above your RMD that you have to take out every year, let's say you earn an extra 4% on top of that. Okay, so if you're taking out 3.5, you're getting 7.5. If you're taking out 4, you're getting 8, something like that. Some long-term 20-year growth number, okay? Not outrageous. So if you compound your account by that 4% a year in 20 years, it's $2.2 million. And the unpaid tax on that at just a federal rate, let's say it's 35, is $770,000. And it's probably another couple hundred to the state. So, I mean, you're seeing 45% of that account in instances where you are like a California or New York, resident where you have a high state income tax. I mean, it's going to be brutal. And so when investors start looking at their strategy, okay, so now, getting back to the new rules, and now that all has to come out in that 10-year period, right? And they have to start doing distributions earlier, right? And so now we have a lot less ability for them to control when and how they pay that tax. Does that make sense?
Yep.
So anyway, these new rules, right? They're going to continue to be restrictive on distribution planning, especially on the inherited accounts, the accounts you leave behind, or the ones that you're going to inherit. We see a lot of our clients inheriting their parents' accounts. It's like, well, now you have to take distributions not only on yours, but on theirs too. They gave you their debt. So like if you can start paying off your taxes sooner with your own Roth conversion strategy before you get those inherited IRAs, that's pretty important for you as well, right? Maybe even talk to mom and dad about a Roth conversion because they're in a low income tax bracket a lot of times. It's too bad that doesn't happen. We don't talk about money with our families in this country.
No, it's like it's taboo.
Yeah, dad won't talk to me, mom won't talk to me. They say it's none of my business. It's like, well, they could convert probably at a 10 or 12% rate. You're going to be at a 35. So, I mean, that's just wasted money. See it all the time. Too bad. Maybe we got to do a class just for that.
Maybe you could talk to my parents.
Yeah, I know. So look, and then the other thing, so when do you want to pay your taxes? Like in low tax brackets, when do you want to do Roth conversion in low tax brackets? Well, so that's one of the components, one of the largest driving components is pay taxes when you're in lower brackets and get that money into a tax-free Roth IRA. Well, we are in the lowest tax brackets we've ever had. And let us remind everybody they're going up in 2026. 10 becomes, does 10 move? No, 10's 10. 12 becomes 15. The 22 goes to 25, the 24 to 28, the 32 to 33, the 37 to 39.6. They're all going up. And maybe even more so, right? That's just the current standard law that happens in 2026.
Right.
When also do you want to look at your Roth conversions when prices are low, right? If we look at this bull bear market,
when do you want to be doing it?
When do you want to be paying your taxes?
In the blue or the yellow?
I mean,
areas?
If we're in a yellow and you've seen the decline, do you want to pay the taxes on the account at that price or at the other side of this bull market run? So, I mean, people during hard times, there's a playbook of what to be doing. We have these recessions. They don't last that long. We don't want to sell and get out of the market, certainly. We'd like to buy more if we can. We're not looking to defer taxes as much as recognize taxes because our income is likely less, our dividends or capital gains. I mean, we're setting up in harder times to have a lower tax situation where these are the times to get really serious about our Roth conversion strategy. And it impacts so much of people's plan. Once they prepare and get serious about their Roth conversion plan, they're going to start doing things differently.
Right.
They're going to decide like, oh, we see people, they paid off their mortgage. They have no liquidity to pay the taxes that they owe. You know, like I paid off my mortgage. Well, you didn't pay off your IRS debt. Why'd you want to pay off the bank and not the IRS? Like that's accumulating at whatever your growth rate is. And if you're trying to earn 8 or 10%, your debt's growing by 8 or 10%. Like, and it's not tax deductible. Like you're just paying it, you know? So it's like, oh, maybe I don't pay off my mortgage. Maybe I think about my capital structure a little bit differently, you know? Maybe I don't take Social Security right away, and I'm going to keep in a very low bracket, get a higher Social Security down the road to execute my Roth strategy. Maybe I don't want to be a dividend hunter during this year and looking at more tax efficient investing things that I can do with my portfolio. Minimize ordinary income, not trigger capital gains. I mean, all these kinds of things have to come into your strategy. Now, maybe even when you retire, like maybe even when you look at it, and this is really interesting when we do this for folks, like, oh, I'm going to work the first 6 months of the year. I'm like, look, let me show you the difference, you know, of what that work is on your marginal bracket versus using this as a year. And you'll be better off working. Always, 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 you're better off working, okay? You're better off making money, okay? Not spending, making, saving. You're always financially better off working. I can't ever see that, but marginally, are you working for 100 grand or are you working for 10? Are you working for 200 grand? We think about what we're getting, or with our tax planning, is it really only worth 50 to you? And how much is that time worth to you? You know, and so that even comes into play, you know, and so I think, you know, these rules changing, I think they're on the margin. I think that it's not going to have a dramatic impact on people who have inherited IRAs. There's some more tax compliance, but it really accentuates the point of what people need to be doing before they get there, and what income in respect of a decedent is, and how much you are going to pay over your lifetime, or having your children pay it, or whoever pay it, unless it's going to charity, right? That's kind of the only get out. But so anyway, we'll stay tuned. We'll keep people abreast of this. We expect more changes to RMDs, IRA distribution rules as the years unfold, and maybe even this year. So I just want to mention that. I think it's just really critical. Now's the time not to put our head in the sand during these bear markets. Use this time to get your tax plan and dial it in with your investment strategy.
Yeah, that was well said. Good stuff.
All right. Thank you.
Don't be silly.
Don't be silly. So, all right. Well, that's it for the Presidio Perspective this time. Okay, got the cobwebs shaken off. Thank you, Jeff, for bringing us some enlightening news. You know, first 6 months of the year were pretty brutal. We went off the air. Market rallied. We're back, and it's going down. What the heck, Jeff? I see a correlation.
Yeah, maybe it's not a good one.
Yeah, we should have a Presidio Perspective stock market correlation chart. No, okay. Anyway, guys, thanks for joining us. We can't wait to have you back next time here at the Presidio Perspective.